Market volatility has been a persistent theme of 2015 on the back of the Fed, the ECB, a falling Chinese market and fears of a slowdown, Greece and the Australian leadership and much more. I spoke with Investors Mutual Hugh Giddy a little time before on his view on the world and how he's investing right now. Hugh, as I said in our intro, volatility has been a major driver of, or a staple of 2015. What have you seen to be the key drivers of volatility, and what's your view on the markets and the global economy moving forward?
Well, it's been a very mixed market. In the US, actually, the market's pretty flat for the year, and you've seen a lot of volatility in some emerging markets like China, where the market's risen very strongly and then fallen back with a very sharp fall. You've had, the commodity prices have fallen a lot as China weakens, and that's obviously caused weakness in commodity stocks in Australia, but you've seen quite a lot of strength in some industrial stocks. So it's as usual. It's a mixed picture. There's things where there are places to make money, or where you have made money, and places where you could have lost money.
So Fed rate rise looming in December. Your thoughts on what's going to happen? Can anything stop it? And if it does go up, will it kill off the prospect of a Santa Claus rally? Do you think a Santa Claus rally can happen?
I always wonder about the stupid Santa Claus rally. There's no good foundation for it, except that it does seem to happen relatively often. I suppose it's because people there's often a news vacuum, and people always think next year is going to be better. Even if it's been a good year, people think next year is going to be better somehow. As to the Federal Reserve raising interest rates, it does seem likely they've sort of communicated as much as they can that they're going to do that. I suppose they still have the option of not doing it, but I think we've got a Federal Reserve that is extraordinarily cautious, and the chances of a significant rate rise are almost nil. We're going to get 25 basis points at most, maybe less. It's been speculated, but say we get 25 basis points. Does that really affect lending behavior or your willingness to borrow and so on? It doesn't. And really what causes companies to consider borrowing or not borrowing is normally sort of more confidence in the future than the interest rate. And in any case, the interest rates at the long end have already moved up and have been moving up, not in a straight line, for quite some months.
And I think that one of the differences in the United States compared to, say, Australia is that most people's home loans are in the US, people's home loans aren't linked to the Fed funds rate. They're linked to, I think it's the 30-year bond rate. So
exactly.
An increase is not going to have a cash flow impact on the hip pocket of consumers, is it?
Exactly. No, it's more a signaling mechanism, because there are very few loans that are based off the short-term rate. So it's more the long-term rates that are important. Yeah. And those have been, as I say, been rising, very much in a volatile fashion, but they have been up. I think the low was middle of last year. Yeah.
So look, it's been a tough year for investors. It's a low-growth environment. In terms of the strategies that you run at IML, how have you been investing?
Well, we've been expecting a low-growth environment from pretty much ever since the GFC, and I think a lot of people have sort of thought that the recovery would be more of a V shape, because that's what other recoveries have looked like in the past little while. Most people don't know how to study history very carefully, and they sort of look at recent history, and so when the GFC ended, people thought we'd get a good rebound, whereas what we're getting looks more like a bathtub than a V. And we've expected that, and there's good reason to expect slow growth, and I believe to expect slow growth to continue. And that's because, firstly, there's so much debt still in the system that sort of puts a cap on how much people and governments can spend. But also a big thing is the aging population, and as big demographic change is going on, it means that an increasing proportion of the population is older and less inclined to consume, and certainly less inclined to consume on credit. And as you've got a sort of dwindling younger population, people who have many working years ahead of them, who are prepared to borrow and spend money that they don't yet have and pull forward consumption, that affects demand in the economy and things like retail sales and so forth. And it even affects things like housing demand. As people get older, they maybe want to downsize, and there are fewer young people who want to be buying a new house.
So where do you see value right now, Hugh, as a professional investor?
I'll be honest, I think it's quite hard to find. We find value in, we're always looking for quality names that are reasonably priced, and so we find value in high quality businesses that are not necessarily the cheapest in the market, but we think they're reasonably priced, like some of the healthcare names like CSL and Ansell.
Yep.
And then we look for companies that are able to make a good acquisition, for example. Companies growing market share, like for example CSL is doing, or Trade Me, which is a New Zealand classifieds, online classifieds business, and sort of eBay combined.
Yep.
We look for companies that are restructuring a bit, and we think the restructuring is sensible, like NAB, getting rid of I suppose the leftovers of many past mistakes of overseas expansion to become a more simple Australian banking business. It gives it something more interesting about that company, say, than the other banks. And so we do look for specific themes that help companies grow in an economy that's not really giving them much of a tailwind.
What's the house view on Woolworths at the moment? Changes at board level, obviously been hit pretty hard. No CEO yet. Are you guys seeing that as a value play at the moment?
I think it's a value play. Whether it's going to make you money in the short to medium term is questionable. It hasn't yet got down to a really low multiple, because I think profits are going to suffer. They've already announced the profits are going to suffer, but I think the turnaround in profits is going to be quite drawn out. It's not that easy to turn around the supermarket business. They've neglected it for some time. They raised price and cut service, and now they're going to have to. They're lowering price and they're having to reinvest in service. It's not a quick fix to change price perceptions, and so I think it'll take some time. What they do with Big W and Masters, I'm not sure. I think Masters is going to be a tough one. It's losing a lot of money, and I don't think it's really easy to sell as it is, and you can't just close it down because they've got long leases on their properties. Yeah. Big W, they probably are able to sell. We have talked to the board, we've talked to the management, such as the management is. Obviously they don't have a CEO. The CEO's role will shrink if they get rid of Big W and Masters, because then it'll just be a supermarket and liquor business. They intend appointing a CEO, but because of the chairman change, it's not surprising the CEO has not yet been appointed.
BHP is obviously another, I guess, blue chip that you'd say has been beaten up. What's the house view there?
BHP is an interesting one. Obviously, you've got to have a view on commodity prices. If you believe that commodity prices are somehow low, you'd be quite keen on BHP. They've got very good assets in the resource space, some good mines, some low-cost mines, very dominant positions in a lot of commodities, and so forth. But I think to come to the conclusion commodity prices are low, you've got to be really one of those people who only looks at the last few years and says, oh, prices are down a lot since 3 years ago. If you look at long-term history, I don't think commodities necessarily look that cheap. And right now, I think BHP gets is getting or has the attraction of a high dividend yield, but we are very opposed to them paying an uncovered dividend. They should pay a dividend based on their earnings rather than this progressive dividends, which basically means borrowing to pay shareholders a dividend. I don't think they should be doing that.
After the break, we'll get an insight into what's happening in the education sector. Don't go away.